Mike, in many ways, the median sort of masks the division, the split on the FOMC. How fine a line is it between 1 and 2 for this year?
You know, Jonathan, it's really a coin toss. I mean, I don't think that's a big deal at all. I think the markets and even the media are making too big of a deal of the difference between one or two. Remember, before yesterday, the Fed had penciled in basically over the next 3 years, 3 cuts this year, 3 next year, and 3 the following year for a total of 9. Now they've penciled in 1, 4, and 4 for a total of 9, right? They get to the same place in 3 years. I mean, if anything, the potential mispricing in the market is what's ultimately priced in, right? The markets are only pricing in 7 cuts over the next 2 to 3 years, not the 9, and stopping there. And remember, the Fed's long-term dot, even though it's gone up, it's still 2 3/4, right? And the markets are almost 100 basis points above that. So in the near term, again, the difference between 1 or 2, I don't think it's possible to make a lot of money trying to bet one way or for or against that. But over the long term, as Jeff Rosenberg said, you know, bonds are cheap.
Bonds are cheap because you're expecting more easing here, Mike? You're expecting the Fed to deliver what they're signaling?
Over the long term, I don't think they're going to stop at 3 5/8 or 3 3/4. I don't think they're going to stop, after 7 cuts. That's what the markets are telling us they're going to do, right? The markets, John, effectively have priced in a permanence of this higher growth, higher inflation, and higher rate world that we're living in today. The markets are really discounting the possibility that you have, 300 basis points of rate cuts at some point in the next 5 or 10 years. And I'll bet that there's a higher probability that the Fed cuts more aggressively at some point in the future than this really sanguine view the market has.